Host for the next hour. He is Keith McCullough, CEO of Hedge Eye Risk Management. Good to have you with us. Are you surprised that this market euphoria that we saw early in the day yesterday, 24 hours ago, was not sustainable?
Not surprised at all. I think the biggest story in the market right now is the currency crash that's occurring in the U.S. I think a lot of people are debating whether or not it is in fact a currency crash. And I think you get Geithner coming out intraday yesterday, starting to push the dates a little forward. He moved to August the 2nd. Only 3 weeks ago he was at May 16th, and then he moved it to July the 8th. But the reality is that he's got problems. He's got a lot of problems. The U.S. balance sheet's a problem. The deficit's a problem. No, it's not a secret, but at the end of the day, this currency crash looks a lot like Q2 of 2008. I think that makes people rightly nervous.
And so the shot in the arm that we saw in the dollar yesterday was certainly no long-term relief from bin Laden. Nothing's going to change in terms of the dollar until we actually get those shorts to capitulate or something goes down in Washington that's meaningful, you said?
Well, what's interesting is that the dollar was making new year-to-date lows, new 2-year lows, new 3-year lows yesterday, intraday, until Geithner did his whispering of sweet nothings, on the central planning side, intraday, to push that date to August the 2nd. The entire market, from a correlation risk perspective, commodities, stocks, currencies, are all trading on what the dollar does. So when Geithner whispers, as I said, these sweet nothings, they have a big impact.
Bernanke sweet nothings?
Yeah, I mean, they're all the same thing.
Look, Keith, we were just looking at this, sell in May, come back in St. Leger Day or September or October. Do you place anything on that, or is it actually things literally going to be dictated by interest rate rises?
Well, I think there's two big points to be made on May. Last year, of course, if you sold in May, there was a 15% drawdown in the S&P to the bottom of August when we had to implement the quantitative guessing part 2 from the Bernanke. But obviously, if you go back to Q2 of 2008, which is also a more frightening, I'd say, period, particularly for the dollar, because the similarities, Ross, between the dollar, gold, oil, commodities between now and Q2 of 2008 are very, very similar. And at the end of the day, a lot of people missed that in Q2 of 2008, and I don't think that will be different this time.
Chloe.
Keith, why is it more frightening for the dollar and all these other asset classes in Q2? Is it because of the end of QE2? And ultimately, what should investors do if it's a frightening time?
Well, if you look at the calendar, and again, this is a very political calendar because to get the dollar right, you got to get the politics right. And to get the politics right, you got to follow these whispers and sweet nothings from the Bernanke and Geithner. But between May 16th and July the 1st, there's a heavy calendar that includes 3 things. Geithner continually pushing, when he needs to refinance the debt, Obama pushing the deficit to the end of June, and then finally the Bernanke ends the POMO at the end of June as well. So those 3 things have never occurred at the same time, never mind with the dollar crashing, and that's why you should be scared about it.
But for the most part, they have foreshadowed some of those sweet nothings.
Well, there's foreshadowing on the sweet nothings, but the reality is that this country has never had to deal with a currency crisis. And what I mean by that is crashing to lower lows. And we've never had a reference point other than Q2 of 2008. So for the people that effectively tell me that we know how this is going to play out, particularly with the heat in this calendar, I'd say the other side of that.
Yeah, but hold on, we're closer to the levels that we were before the bank collapse.
Well, that's the point. Before the bank collapse, the minute that the dollar, that was the all-time low for the dollar, the U.S. dollar index, going back to 1971 when Nixon politically abandoned the gold standard and devalued the dollar. So if you go back to that period, the all-time low in the dollar is not a good reference point. And by the way, when the dollar stopped crashing, everything else started crashing. And that's the point. That's called correlation risk. The correlation risk between dollars and oil, dollars and gold, dollars and everything is at its highest point ever. And as we like to say, ever is a very long time.
Indeed it is. Our poet this morning, Keith McCullough, CEO of Hedge Eye Risk Management, sticks around as our guest host for the entire hour.